All righty, here you go. Okay, so getting started, I am really happy to have this conversation because I feel like we have so many phone calls that and emails that just go really quick, really easy, but so many folks don't have access to this information. So I am here with my good friend David Gomez, and honestly, brilliant mind. You are somebody that I've been referring people to left and right because you are not only knowledgeable about all the programs and answers when it comes to mortgages and lending, but you will also go out of your way to find answers when you don't have them. And to me, that's how we really advance our field, our profession, and really help people truly make a difference in their lives when it comes to making these big purchases. So, David, we got three hot topics today. Do you want to introduce yourself first before we get into them?
I'm sorry?
Do you want to introduce yourself a little
Oh,
deeper before we get into the hot topics today?
yes, yes. So David Gomez with Gulf Coast Financial, mortgage loan originator. We're broker out loans. We work with different banks, and I've been in the industry for a little bit over 3 to 4 years. In the real estate industry for about 15 plus years. So, yeah.
I love it. Do you feel like your knowledge in real estate goes into what you do in lending, like on a day-to-day basis?
It does. It did help out a lot on my transition over to mortgages, because I kind of understood the whole layout of real estate in general. But the inner workings of finance is completely different. It's a lot of stuff, a lot of moving parts that I did not know. You know, being an agent at one time, and no longer now more so a mortgage loan originator. Yeah. So it's a whole different large world, definitely. Yeah.
Yeah, as a newer agent still, I think it's so interesting that the things that we get tested on and that we're told we need to know in our first year is not really the stuff we're doing on a day-to-day basis that would
Oh,
actually help the clients we're working with. Every question that I've asked you that we've talked about has been so much more helpful in informing clients and making sure they're making like well-advised decisions, so much more than anything I took on the test.
well, I'm glad I can help in any way, shape, or form, honestly. And you're a rock star. You're climbing up quick. You're so knowledgeable. You absorb everything so well. I'm like, wow, I'm blown away. So
Thank
yeah,
you.
definitely,
I told my
definitely.
brother I was just a spongier. I'm here to absorb as much as I can so that I can pour it back out.
Yes, absolutely, and that's the way. And hands on, right? Always applying is the
Exactly.
best way to learn. Always, definitely asking questions too as well. Hmm.
All right, well, let's dive into the first one. So, a lot of the folks that I am serving are first-time home buyers or
Hmm.
want to be first-time home buyers, but aren't even sure if they have the financial ability to get their first home. So, I know it changes time to time. We talk about FHA loans a lot, and a lot of folks don't even realize that FHA does not stand for first-time home buyer. But
I didn't know it does not.
tell us a little bit about what programs are out there right now for first-time home buyers that you would recommend us looking into.
Okay, so I mean, let's kind of go into it with the first step of talking about FHA as well, because believe it or not, FHA is not just a first-time home buyer program, but it does help first-time home buyers. As little as 3.5% down on FICO scores from 680 and up, which FICO scores is your credit score. Um, Anything less than that, 500 FICO score, you can still go with FHA, but it's 10% down.
Okay.
So you can have a less of a FICO score, but it is more down. But that's your entry level into, first time home buyers. FHA is very good. Interest rates are good. They're very flexible, on certain things, as far as like the debt to income and then the housing income ratios, the way that look at when we're pre-qualifying buyers, borrowers to get to that point. So, definitely FHA is great there. Another one is everybody's talking a lot about is the Dream Draw, right? I mean, everybody's
Yes.
excited about that program, and it's really cool. It's innovative, and it's yeah, I just came in like a storm the first time. Now it's coming in the second round. This time I think it's like from the 6th April to the 30th is your cutoff times, right? So for that program, and I know you know about it because we were talking about it a little bit in the past, is a share appreciation program, right? So
What does that mean?
20%. Well, what that means is pretty much what the way it works. The program is they're going to give you 20% down, right? And
Mhm.
then once you qualify for it, you go forward. Then when you build up over time, you are going to share equity share with that back. So 20% in, and then you also have to give 20% of your equity build in the program if you were refi or sell property down the road. right? So that's why it's called the shared plan. But
When you
yeah,
say
but
that, does that mean like essentially that it goes back to the government that's providing
yes,
programming? Okay.
that is correct. That is correct. Yes, yes. Alongside with their 20% that let you borrow in the first place. So very, very, very good program. It's very innovative, but it's very limited though too. I would say that that is one con about it. It's not a bad thing, but it's found is that it's vouchered.
Hmm.
So when
A
it first
lot of
comes,
stuff and
oh
like,
yeah, yeah,
ugh, that's
definitely.
scary.
So if you're interested in that program, any buyers, talk to Lolo right away. They need to talk to you. You need to get that stuff ready to go, get pre-qualified, get that in there, and get set quick because once it comes, it'll come, and once it goes, it's gone. You
Right.
know?
April 6th is right around the corner. It's going to
Oh
come soon.
yeah, definitely, definitely. Now, let's just say, for example, there's a challenge getting into that program.
Yeah.
Okay, there are other programs. Calahafa, which is also part of that body, that family of down payment assistance programs and family, they have different options. They have one where it's you can do a conventional Calahafa, 3% down. Okay. You can also do a FHA, 3.5% down Calahafa. You can do a 5% down for conventional jumbo loans. But here's the thing about that is that Calahafa, just like the Duke for All, you have to take eligibility, like a course for first-time home buyers prior to close of escrow. That's part of it. Everybody has to take the educational course. And going back really quick to the Dream for All, you also take the shared program, the shared appreciation portion of the education as well. So I forgot to
Mhm.
mention that that's part of it. So 2 for the Dream for All, 1 for Calahafa. Yeah.
Yeah. More of like extra air. You have to go take a course or do this extra layer of work to get the funds. I actually like that you have to take a course because it just helps us with our financial literacy, like as we
Yes.
build our communities around wealth building mindsets. We don't talk
Yes.
about it enough. So taking
You
these
know,
courses would actually really help us have these conversations more.
absolutely. It's powerful, right? It's knowledge is power, especially in finance and then real estate. It's going to help educate, like you said, communities, everybody, right?
Yeah,
So
we need
they
it.
can kind of share that along too as well with everybody else that they know. But now there's also another program. So Calahafa has many, but there's another one that we have for a bank that's called the Empowered Grant Program. Okay, this
Okay.
is very interesting though. Okay, so like the Dream for All and Calahafa, they have income limits, right?
Okay.
Certain income limits that apply depending on location and county and everything. The Empowered Grant Program, 3.5% down grant or a 2% grant. Each one has its interest rates tied to it. I think the 3.5 is 7.76 is the interest rate tied to it. And then the 2% is 7.235. Okay.
Okay.
One or the other. The grant is you get the grant from them. You do not have to pay it back, but
Mhm.
you do have to seize the loan. You have to make at least 6 to 7 payments in the property as a primary owner. So you have to live in the property. It's not for investments at all. And just like Calahaven, and just like the Dream for All, you have to live in the property. And after that, you can sell the property, you can refinance out of it, and you don't have to pay the money back. And there's no income limits. So that's great. Also flexible is the FICO scores. I
Okay.
think you've gone down to about 560 and up to get the grant program. So
Okay.
that's really, really good. It's a good way to get into. Um, if you can't get into that one Calahafa or the Dream for All, the grant program might be a great opportunity for first time home buyers as well. Okay.
Absolutely. So it's a rule of thumb that the better your credit score, the less percent down you have to put in, and vice versa.
Correct.
Worse the credit score, higher amount
Yeah,
down.
that's
Okay.
right. That's right. There's a lot of little things that I mean, we could do a 6 hour talk about all the stuff that goes on with these loan programs, but that's why when we're calculating and we're looking at financials and all this stuff, it all depends on numerous things. Your
Hmm.
FICO, your income, your debts, how credit looks. Because some people might say, well, I have bad credit. Okay, you have 560,
Right.
580. It's considered bad credit, but you may not have a lot of problems in the actual credit. You may have to just check out a couple of things and bring up credit scores. There's some people that have good credit, but they may have challenges inside their credit. Like they may have disputes, right? What people don't know is that disputes affect as well as how lenders approach the loan. They don't like disputes, right? That may
Mm.
kind of cause them to kind of say, well, we need to make sure that dispute's taken care of prior to us completely moving forward.
Okay.
And that's across the board with a lot of different programs. So
So I'm glad
yeah.
you bring this up because I think a lot of the folks I talk to are like, "Oh, I'm working on getting my credit score up before I, apply for a loan or meet with a lender." Kind of using it as that step beforehand, but I feel
Mm.
like it would almost be better, my perspective or opinion, to meet with you, get pre-qualified, pre-approved, know what's actually going on before working on the credit score so I know what I actually can get and what my goal is. Would you
Yeah.
recommend that or am I on a different track?
No, no, no. I think that's brilliant. I think it's awesome the way you think because they're working on it, which is great because that means they're responsible. We're trying to take care of it, right? And
Right,
you
totally.
want to take care of your credit, but I think definitely just look at it first. Let's take a look at it because we don't know how close or how far away we are to
I'd
that
be
next
surprised.
step. You would be surprised. You might say, "Oh yeah, I've checked. It's like 580. It's not good." Why do you know? Maybe you qualify for a loan right now.
Right.
It might be able to get you into a home. You just don't know about it.
And correct me, but credit rating and credit score are different, right?
Yes, that's correct. Right? It's just like also another thing that people don't understand is that APR and interest rate. Right? Another thing kind of have to
Yeah.
deal. APR is the cost of loan. Interest rate is the interest rate to the loan, right? So
Mhm.
yeah, the credit rating and credit, yes, credit score definitely. Also, when we look at the credit scores, when we pull your credit scores, we always look at the middle score.
Okay.
That's how we look at credit scoring. So middle score is how we look at it.
Middle
Mm-hmm.
school. Okay,
Mm-hmm.
taking a note on that one. Okay, I love that. This is helpful because I think we throw around terminology to be like, okay, think about this, and almost like use it as a checklist. But if you don't actually
Right.
understand what you're looking at, it's not going to help you in your decision making. So these are the
Right.
terms that we need to actually understand better.
Exactly. I mean, I had a borrower going, well, what's my APR? It's like, well, the APR is this. Well, why is the APR higher than the interest? Well, the APR is the cost of loan, and the lender's probably not going to change the APR. It is what it is, you know. Interest rate, you can negotiate, you can find out clients, you can do different things to kind of offset that, you know. But APR usually is concrete. What the lender's
Okay.
going to.
So if you read your APR stay, but the interest rate changes.
No, you can actually, if the APR and interest rates change, because they usually go in conjunction, right? If they drop, they're both going to be dropping together. Yeah. Yeah. For the
Okay.
most
And within your timeline, both are going to change.
yeah, for the most part, correct. Yeah.
Okay. Cool.
Mhm.
Well, I feel like I'm ready to hop to the second one, but any other recommendations for first-time homebuyers?
I would say just get your information over to Lolo as soon as possible and to me, and let's take a look. Let's take a look at the picture. We just don't know. So definitely.
Exactly. We just gotta look at the picture and then make it work for us, make a plan.
Absolutely.
Okay, so another client I'm working with, they've had questions about VA loans recently, particularly pros and cons of VA loan because it seems like the word around the block is that like the VA loan is the best thing you can possibly get, but they also had concerns about it. So, what do you see are the pros and cons from the lending side?
So VA loans, are phenomenal loans. This is for active and non-active, you know, members of the military family, active members. It's great. 100% financing. Most of the time, there's no loan limits for the most part. For most lenders, no limits. Those are pros. There's no PMI, which I think we talking about PMI. There's no PMI to the VA loan, and then also your debt to income sometimes can be if it's not good on FHA or conventional, for VA may be acceptable. I mean, they may not worry too much about that, right? So, I mean, there are a lot of pros on that. And then also as well as, eligibility for them. Usually most of the time, get a certificate of eligibility as being a military member, they're probably going to get their VA financing, from
Right.
the bank. Yeah. Cons, I would say more so sometimes when you approach a property and if it's a hot market, you might have a very hefty conventional loan with not a lot of contingencies that may kind of hurt you if you're using a VA loan. But, I mean, with great negotiation, a great agent like Lolo, you can make it hard and you can make that loan look really, really good though. But the cons would be that I would say so is sometimes, the competitiveness in the market and then the contingency time frames, especially for VA loans. Also, another thing is that when you do VA loans, if there's any pest, damage or anything like that, it has to be clear prior to close of escrow.
Mhm.
It's a must. Before they didn't let the borrowers pay for their own inspections. Now they're allowing it.
Right.
Yeah.
Right. And those are good points because, decoding a little bit when we talk about contingencies and timeframes, we're really thinking about how long is it going to take to close escrow? Because if you are
Right.
selling your home, just imagine you want your home to be sold, you want
Mm-hmm.
deal to be done, money to come in, and then you're like, okay, I'm ready for my next step, next season of life. So sellers are going to look for that process to be quick. And if
Yeah.
your escrow is going to take 45 days, which I think is pretty typical for a VA loan, right? Around 45.
Yeah, around 45. It also depends on the lender. Some lenders actually can move pretty quick as long as they get everything cleared out. But typically 45 days.
Yeah, that's going to take way longer than an all cash offer. That's like
Absolutely. Oh yeah. Absolutely. But I'm gonna go back to some of the pros on
Yeah.
it too as well, is that, their interest rates are very, very competitive. They're
Mhm.
lower. Also, when that veteran gets into that loan, they can actually do, a streamline refi into another VA product, and then it might be even better interest rate. Even if the interest rates went out a little bit, this might be get favorable interest rates. So
Mhm.
there's very, very, very good loans, especially for them. And yeah, definitely. Another con is that since it is 100% financing, you're not putting anything down. Most of the time, when you put down money, you're buying into the actual property and you're building equity off the back, right? Well, okay. So you buy with the VA, it's 100%. You kind of don't have too much equity cap yet. It might take a little longer. So, that's one of the cons. And I mean, other than that, there's not too much that's bad about them. And then very, very good loans. Also,
Just
the VA funding fee, I forgot to mention.
funding fee. Okay.
So usually funding fees are anywhere from like 1.5 to 2.15 of the loan amount
Okay.
that is charged. And again, that used to not be, they used to pay out of the pocket, but now they're allowing it to be financed into the loan as well. If they use it again, their VA privilege down the road, when they actually pay off this and they go into another option and they get to another VA loan, the fee does go up. So that is a con, right? But again, if they're able to kind of finance it and roll it into the loan, they at least they will kind of have to pay out of pocket up front. Yeah.
Right. And when you were talking about there's no pests or things, that kind of goes with the general rule of safe and sound, right? So
Yes,
you can't look for a property that needs a lot of fixing, or if you
that's
want to do
correct.
the for investment process, like that would not go well for
No,
a VA loan.
no. I don't even think they allow the investment option for investment properties. It's mainly for primary residences. You can do a spouse and a member. It could do two members. Um, active, non-active together, and they can both use or one can use. So there's a lot of good stuff about the actual VA process as well. So.
Okay.
And then
Oh,
VA,
get it.
VA guarantees a lot of it, if not all, the actual loan for the bank that's servicing the VA levy.
Okay. So when we talk about the bank servicing the lending, if somebody wants to go through buying a home with a VA loan, do they need to go through the VA and then they'll connect them to a lender, or can they go to a lender first? Does it matter the order?
They can go through the VA, they can ask them, and they probably have a list of lenders that they actually work with, and credit unions that are for military or banks that they work with. But there are a lot of banks that are definitely certified and under that, the umbrella for the VA that work with them, and they have a lot of experience doing those VA loans too. So
Cool.
yeah,
So even if they wanted to, and then connection still.
that's right. As long as if they're active, they get their certification of that certification, or if they're inactive, I think it's a DD2, it's DD
Like an eligible
214, DD 214 form that they get. Yes, that they've served and they've been released on service already.
Okay. Perfect. Okay. Anything else we should know on VA loans?
No, they're great. So if you're a veteran, talk to Lolo. We can get it done for you.
Absolutely. And spouses of veterans, this is an important one too. And I know that's been a big process for folks, is like, what does that look like if your spouse has passed? Like within a certain time frame, you still have to work with your VA to get that letter of eligibility, but
Yep,
that's a possibility for you to consider.
absolutely.
Advantage that you want to take.
Absolutely, 100%, definitely.
Cool. Okay, so our last hot topic of the day. Actually came about in our conversations with how do we make sure we have financing options for entrepreneurs and folks who don't have typical tax statements. So you told me about creative financing. So could
Yes.
creative financing a little bit more and when we would use it?
Sure. So creative financing, again, it's broad, but in the sense of entrepreneurs, 1099s, business owners, sometimes when they're, business owners, they pay themselves with a W-2 or the paycheck, and they get money from that, and they also do have their business tax. That's fine. There's nothing wrong with that. They may qualify for a pretty good amount with their income tax, but they're probably going to qualify with more for the bank statements, which is the creative part of the financing. So you're going to leverage your business as your income. So
Mhm.
usually they get about 12 months, sometimes even 3 months of bank statements. And then the underwriters and the bank will average it out. And then that will be your applicable income.
Okay.
So you can go from like 600,000 to a million to $2 million of income to buy a property. So
Yeah.
yeah, and
Because we know
there's
a lot of business owners don't have a habit of paying themselves. It's usually like kind of
right.
recycling through the business. So it's like, well, we do have the funds, but we just don't have individual records to show it. So
Yes,
it seems like
exactly.
homeownership is out of reach when we're looking at a tax statement like that. But realistically, it's not if we just use different documents.
That's correct. 12-month bank statements, ID, your social. Even for the foreign nationals, ITINs, they actually can use ITINs to be able to actually buy with their business, and then your bank statements, and then a CPA letter that
Mhm.
the business is in good standing and it's healthy enough to be able to take on the actual finance.
Okay, so the programs we were talking about earlier, the first-time homebuyer programs, like when we're talking about CalHFA and FHA loans, do those still work with these creative financing documents, or are there completely different programs?
No, well, they can, as business owners, they can actually go apply as long as they have income. They can apply income, they can still calculate the income and then apply for one of those programs. But most of the time, they make a lot of money. So when it comes to CalHFA and Drew for all, they're probably going to take themselves out of there. But for the
Mm,
empowerment grant program, it might work, right?
okay,
That's if they want to use the grant. But of course, they probably have a lot of money, so they're probably not going to need to use it. But hey, you never know. You don't know what their situation is. If they can apply for it, why not? Right.
right, exactly. So
Oh,
when I send someone your way, we're helping them gather these documents, making sure we go through that checklist, and then it's a matter of, well, these are the ones that you're eligible for. Which one do we want to go with? Is that
we'll look at everything. We'll
Mhm.
kind of check income, debt, credits, all the stuff, and then we'll see what suits them better. We offer them the options. We may think this is a better program for them, but they may like this program.
Yeah.
You have to go with what they want to do ultimately. But we're going to recommend maybe you should probably go this was a lot better for you, but this is what you want to go with. It's your decision. You can definitely go that way. They have the choice, right? But yes, definitely check everything, and we'll see where they fit and what is available to them for sure.
Mhm.
100%.
And typically, I consider that process the approval process. There's been a lot of conversation about whether we use the language of pre-qualifying versus pre-approved. Um, do you recommend one or the other, or tell folks that there's a difference when those two words are thrown out?
There is a major difference. Pre-approval is vetting everything and then giving an estimate. Pre-qual is them stating information on an application, and that's just gathering information, but we don't have everything in
It's
hand.
not bad.
We may not even run credit. We're just taking word for it, and we're giving them kind of like a rough estimate up front. Where
Okay.
pre-approval is a lot better. You actually run through systems. For example, conventional FHA, we run through our, AUS system. We're running that's an underwriter, and it kind of gives us an eligible approval or eligible referral or whatever it gives us. We have a better idea. It's more solid. So yeah,
Okay.
pre-qual, pre-approval is completely different. Yes.
Okay,
Mm-hmm.
gotcha. So pre-approval is really reliable. Qualified is like not really the best route unless you want to be
No,
surprised at the end.
right. And we're just talking. I just say pre-qual, just when we're just talking and giving
Yeah.
them an idea. But I just tell them, I said, look, this is a really rough estimate. I need to see everything prior to me even giving you a pre-approval, honestly,
Yeah.
to give you a
Yeah.
better idea. Yeah.
That makes sense. Okay. Yeah. I think this is so good. Some of the things that I'm like taking away too that I want to talk more about maybe in future videos is some of the language itself. So we talked about APR versus interest rates, credit scores versus credit ratings,
Hmm.
what all these acronyms actually stand for the folks who don't work in this business. So FHA, CalHAFA, we like throw these all out, but people are like, I don't know what that is. Like, what is Fannie Mae? People always ask. Like,
Man, Freddie Mac, Freddie Mae, who are they?
right.
What do they do? Exactly. Exactly.
Exactly. So they're thrown out. They know it has to do with money or loans or debt in some way. We just kind of have this big scary cloud over our heads of knowledge that we have not yet learned. So that is the goal of sharing this. But I am liking that this is just the first conversation that we're having aloud to share with other folks what kind of happens behind the scenes on our phone calls. What do you think we should talk about next time?
I think the next topic we should talk about, which a lot of people are not really looking at, is something that you and I briefly talked about before, is the bridge loan.
Mm,
The bridge loan is a great option, and we'll get into really.
so
We
true.
can even have a conversation about that program in general. I mean, there's a little bit to talk about that program, how it works, and where it can take you, and how it can deliver and help the seller get into the next step.
Definitely. Maybe we'll have like a whole session on what it looks like to sell a house for the first time and what your options are with the bridge
Yeah,
loan, those topics.
that sounds awesome.
Okay.
I'm in 100%. Just let me know when I'm here.
Let's do it. Awesome. Well, thank you so much, David. I think this was perfect in answering a lot of the questions that I'm receiving and making sure I can give some credible information back. And we're definitely going to keep this going and providing more info. So if you're listening in on this and want to hear more from David and I, just send us your questions. Let us know what you want to know about. And of course, you can connect with David directly too. David, do you want to provide your information so they can follow up with you?
Sure. You can reach me at my phone number is 408-717-3814. Again, 408-717-3814. My email is D as in David Gomez at realestaterepublicinc.com. You can also get me at David underscore RE, and then that's my Instagram handle.
Perfect. If you're watching this on YouTube or listening on the podcast, I'll include it in the description as well below. And if you're watching or listening, you found me, so you know how to reach me. But let me know if you have any questions or if you want more advising on either the lending process or the real estate process, and we'll get you connected. But
Yes, definitely.
wow,
All right. Thank you. Reach out to Lolo, guys. Let's get the real estate going.
let's
go.
do it.